Dennis, thank you so much for joining us today. I know you have this new report out on the subscription industry, what's been going on, and the forecast ahead. But first, I want to take a step back, looking at the market sell-off today and your broader focus on media, entertainment, and telecom. What's your outlook, considering what's been happening with these stocks?
Yeah, well, it's great to be with all my old friends. Nice to see you, Julia. The conclusions from the subscription economics report actually square pretty well with what's happening in the market today. We surveyed and really benchmarked 20 different companies that are based around consumer digital subscriptions. And what we found was not the healthiest of pictures, that the expected growth rate for those companies have gone down on the revenue side from 24% through 2023 to 8%, and EBITDA growth basically down to 0 for the next few years. And the stocks have responded accordingly. And everyone can see the red on their screen this morning and certainly understand what's happening. And subscriptions are a very good way to understand what's happening in that discretionary spend is being pinched. And there was the idea that the consumer would hold on in lots of different ways across the economy, where when it comes to subscriptions that are perhaps not a must-have but nice to have, they are choosing to spend less on those. And because of that, the discretionary spend is just contracting, and the companies that are selling those subscriptions have to do business in a different way.
Yeah, certainly gives a good sense of the health of the consumer. But looking at the sell-off at all of these stocks today, many of these stocks are trading way down over the past year.
Yep.
Wondering if you think the entertainment sector in general is investable right now, or if there are just too many risks and uncertainties.
Well, look, there's a couple of different ways to look at this sector. Advertising is certainly one of them. Again, all directly related to discretionary consumer spend. Subscriptions, as I mentioned, is an area that's being pinched. Travel experiences, I think, is a bright spot relatively for the entertainment industry. And you can see that in terms of the number of concerts that people are willing to attend and spend money in that way. But look, across the consumer sector, Julia, we're seeing just a total recalibration because inflation is changing people's budgets. So when it comes to people making investment decisions, they just have to do their best guess, because it's very hard right now to determine exactly where inflation lands and exactly where consumer behavior holds still. So in that context, I'm not surprised that people are choosing to sell as they are today.
Hey, Dennis, it's Deirdre. Good to see you. So what does this all mean then for the trade-off between profitability and content spend? Do we see some of the streamers and the legacy players pull back next year, obviously in very different positions? You see in Amazon, right? I'm starting to get the boxes with the Thursday Night Football advertisements on it, part of that flywheel. Who does pull back, who doesn't?
Well, look, I think it's a very good question. There are certain companies for whom entertainment and streaming represents a new opportunity, and they're willing to spend money. But I think that when it comes down to it, those people that stand in investment committee meetings that make decisions whether to buy stocks or sell stocks, they're asking themselves, what is the true profitability of the enterprise that's being conducted? And whereas growth was the mantra in 2021, as we all experienced, certainly profitability is the mantra today. And I expect a few things to come out of that, Deirdre, real quick. One, scaling back of lower growth lower cost subscriptions, potential for more mergers and more bundled subscriptions in a way that gets us back to the cable bundle. And third, I expect there to be just a change in who people are willing to target as subscribers. They're just going to be less spend trying to acquire each individual customer.